There's a term that we have been trying to use more and more often because I think it's really instructive. It's called tax maximization. That doesn't mean trying to pay as much tax as possible, but it means maximizing advantageous tax moves. And sometimes advantageous tax moves do mean paying more tax now and choosing to control your tax wrapper or your tax bill as opposed to always pushing things down the road. If you always push tax down the road, you could end up with unintended consequences that constrain you later in life. So I know I just went off on tax maximization, but I think it's a good conceptual overlay for how, the questions that we ask about tax.
Right. Yeah. Tax planning wrapped up is either increasing your income or decreasing your income. Both have strategy, and both are strategies when you look long term, trying to control your tax landscape, soaking up ideal brackets or not.
Mm-hmm.
And so this is trying to reduce your overall long term tax drag. And so just a few questions. We are not going to hit them all. But I just made a list of, again, patterns, right? Themes. Does my company have an HSA? That's the only triple tax advantaged account, right? Does my health, align with a health plan, a high deductible plan that could pair with an HSA? And how am I using it? Am I investing it? But that is a triple tax advantage, right? And for high income earners can, save thousands in tax.
Yeah, yeah. So the 2025 family contribution limit is 8,550, and that's just a deduction that you get on your taxes. And like Allison said, it's triple tax advantage, right? So any growth in that account is tax free, and then it comes out tax free, provided you use it for medical expenses. So yeah, this is a powerful account, although relatively small in the big picture of things.
Right. So right now we're talking about income decreases, strategic income decreases, or a CPA would say deductions, right?
Mhm.
So we're going to talk about decreases and then increases that are strategic as well. So another big lever for an income decrease is if maybe this particular year you want to pull the lever of the pre-tax 401k. I've been adding in Roth, but this year, looking at my overall long-term tax drag, it makes sense to take an in-year deduction and switch to pre-tax, right?
Yep.
Again, another lever. Or make a donor advised fund contribution if you're charitable, right? Or even in your investment accounts, is there like a brokerage taxable individual or joint account? Is there an opportunity for me to harvest losses? It's called tax loss harvesting, right? Or swap stocks that are advantageous that will actually help me from a tax perspective.
Yeah.
Like similar stocks like Pepsi and Coke, and one's up, one's down, and I can actually capture a loss and help my taxable income.
Yeah, and I think even to just zoom out on the deductions for a moment, like a lot of what we're talking about and thinking about here are when you have peaks and valleys of income, but particularly with deductions, peaks, right? Are you getting a really large bonus, a large equity compensation payout?
Mm.
Say you're getting several hundred thousand of company stock that you are being taxed on this year, and you're charitably inclined, maybe you want to make 10 years worth of donations to your charity of choice into a donor advised fund the year that you have a peak, so that you're not taking money out of your bank account the next 9 years, but you've effectively reduced your taxable income and reduced the income that's in higher tax brackets in this year where you get the big payout. So I just want to back up for a moment and think concretely of like, okay, what are some of the triggers where we might want to really look at minimizing tax for a current year and the ways that you can do that?
Yes, income spikes are some of my favorite times to plan. So when you're receiving a large, whether it's an inherited IRA or you got a huge promotion or you have a huge equity comp, that's vesting, and income spikes have so much opportunity for planning, and it might delay decisions that you would make. It might delay selling your home, selling a certain stock in your portfolio that's going to push you into the higher capital gains rate, or other strategies you might look at for these strategic deductions that you're working through with a financial planner and saying, and CPA, and saying, okay, we're coming together and we're going to make this strategic deduction, this move to get a deduction, because of this income spike.
Yeah, and I might even just highlight one more that you touched on briefly of, should I consider waiting to sell certain assets this year? Just a thing that I haven't seen many people be aware of is the capital gains tax bracket. So when we're thinking of selling homes and selling traditional assets like stocks that have a gain on them, You have a capital gains tax bracket that is calculated similarly to your ordinary income, but on top of the ordinary income you earn in the year, it also starts to, or it tracks gains. So if you have $200,000, of a gain on a home, that adds to your capital gains tax bracket for a year. And people don't always think about this and can inadvertently push themselves into a higher capital gains tax bracket on a high income year.
Okay, so questions to ask about strategic income increases. So we're still in tax. Wow, we've been in tax. Well, the tax is so hard because it's so specific.
Yeah.
But let's just run through a couple opportunities where we see that it's advantageous for a client to make a strategic increase in income, which sounds wrong. But again, think overall tax drag, right? Soaking up advantageous tax brackets. If we have a little bit of a wiggle room, right? If there's some wiggle room in the 24% or that's when strategic increases may or may not make sense.
Yep, yep. Yeah, and I think even terms that so soaking up favorable tax brackets is, if you've talked to us, a term that you might have heard Allison say. I think even just double click on that. Like what we really practically mean is, maybe your total income for the year is right smack dab in the middle of the 24% federal tax bracket, which in current tax law, we consider that a pretty advantageous tax bracket and tax range. So when we say it's like soaking up, it means, okay, maybe there's $50,000 between me and the 32% federal tax bracket. Do we want to consider a tax maximization strategy where we choose to pay more income or to realize more income in this year so that we can lower our long-term, multi-year, multi-decade tax burden? So that just to even unpack a little bit what we mean when we're saying tax maximization or soaking up a favorable tax bracket.
Yep, exactly. And one way where you would, and you may have heard this term, Roth conversions, that's one way where you would soak up, right? So when you make a Roth conversion from, for example, IRA to Roth IRA, or if your 401k allows, within there, but that shift and conversion of money it increases your taxable income. So that would be a soaking up, right? Because you've decided with your financial planner that, okay, this year and to the best of our ability looking forward, it actually makes sense to soak up my favorable bracket at this time.
Yep. Yeah. A lot of this has to do with Roth, right? Because to contribute to Roth, you're choosing to pay tax this year. To convert to Roth, you're choosing to pay more tax this year to move those funds into Roth. But even like, another flavor of this, inherited IRA. So if you have an individual retirement account that has been passed on to you, there are distribution rules. They changed in 2020. So it depends whether you inherited it before 2020 or not. But regardless, you are going to have some rules about how and when you need to distribute it. Might a current year, as you look forward, it might be more advantageous to take more out because, right, it's a big pot of money that hasn't been taxed that you're going to have to pull and get taxed on. So there may be a year, it could be this year, it could be an upcoming year, where you see a valley of income coming up and it's like, well, let's fill up some income from this IRA and get some of that tax burden off our balance sheet.
That is so well said. If there are peaks and valleys that you can determine because, oh, I'm going to make more money this year, or I'm going to take a 6-month hiatus from working this year, or I'm making income deduction strategies this year, so I'm going to withdraw more from that inherited IRA.
Mhm.
This is what we're talking about.
Right, exactly. Yeah, and that's how these things start to play with each other, right? If you are doing a Roth conversion and raising your income, maybe that's your move and you don't necessarily want to pull more from an inherited IRA. But yeah, like you said, if it's a higher deduction year or a lower income year or a combination of both, then getting more of the inherited IRA into the bank account outside of the tax deferred space may make more sense.
Absolutely. Yeah, so and there's different ways you might choose to get money into Roth too if we kind of go back to the Roth conversions, right? It might not be through Roth conversion, it might be through just a Roth contribution or a backdoor Roth IRA or that's currently allowed within current tax provisions. So there's different levers here and they all work together and that's really where, especially if you're thinking about soaking up or, increasing income, so sucking up in your current favorable tax bracket, that's when you wanna be really aware of your surroundings and other levers that you might be pulling.